It's Friday, 28th of February, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, Trump tariffs, what the threat looks like from India. But first, Neil Shearing, Group Chief Economist, is back with me to zip through what's happening in global macro and markets. Hi, Neil.
Hi, David.
So, tariffs and more tariffs. A Truth Social post on Thursday from the president saying that the tariff scheduled to go into effect on March 4th will be going into effect. China likewise to be charged an additional 10% tariff on that day, so on top of the 10% that went into effect earlier this month, and that the reciprocal tariffs scheduled for April 2nd also happening, with the usual caveat that it's 9 a.m. in Washington and in Mar-a-Lago for that matter. Things are fluid. This sounds like a huge wave of measures is coming, but we've seen this movie before, so how seriously should we take these threats about this latest round of tariffs?
I think it was someone in the first Trump term said that we should take Trump seriously, but not literally. I think that still stands. That the bottom line is here, we can have a conversation about what tariffs might come in and what might not come in, and whether Trump will have another 11th hour U-turn. No one knows. So I don't think anyone knows here. So rather than thinking, what's the hot take on whether these tariffs come into force or not, we should start to think about the effects if they were to come in. I think a couple of points stand out here. First is that it's interesting that there's not just the fact, essentially, the 25% tariffs on Canada and Mexico coming in next week, but also an additional 10% on China. So yet again, China in the firing line. We put out a piece over the past week looking at the response of the Chinese to tariffs and the Chinese leadership to tariffs. So far, the renminbi has been conspicuous. A renminbi depreciation in response to tariffs has been conspicuous by its absence, but that could start to change. That's the key thing to keep an eye on there. And then in terms of the macro effects of tariffs, a much, much bigger deal for Mexico and Canada than it would be for China or for the EU for that matter. So if they do come into effect, we'd expect the impact on both Canada and Mexico's economy to be substantial, potentially pushing both towards recession. But whether they do come into effect or not, no one knows. I think that actually the final point to make on that regard is that they may all come into force, but then be rolled back as either the extent of the economic dislocation and damage done and created across the North American economy becomes clear, or because governments on both sides of the border take actions to ameliorate Trump.
Or indeed, if the financial market reaction gets nasty. I mean, you touch on this point, don't you, that we are in this very uncertain world and so much depends on the whim of one man. And clearly, this uncertainty is taking a toll in financial markets. But are we seeing economic costs at this stage to this idea that we could be staring down the barrel of a trade war?
Yes, it's a good question, and it's one that's come up a number of times in client meetings over the past week or so. And that is to say, is it the uncertainty surrounding policy changes in the US that could have an effect on economic activity that in the US economy and the global economy, as much as the policies themselves? And it's really something that's incredibly difficult to answer, at least with using empirical evidence. Now, one way some analysts have tried to capture this is by looking at various different measures of policy uncertainty, which of course have shot up over the past month or so, and plotting that, for example, against measures of global trade or GDP growth. But I think there's a danger that conflates causation and correlation, because often it's the case that when policy uncertainty increases, it's because the global economy has experienced some kind of shock. So if you think about 2008, the global financial crisis, we saw a surge in policy uncertainty, unsurprisingly. If you think about the pandemic in 2020, we saw yet again a surge in policy uncertainty. And in both cases, of course, activity cratered. But likewise, in neither case was that due to the rise in uncertainty itself. It was due to other factors. So I would be a bit skeptical about drawing some of these charts that show increases in policy uncertainty alongside decreases in activity or economic slowdowns. Now, what can we say beyond that? I think it's important to recognize that uncertainty can take many different forms. It could be around policy. It could be about the economic outlook more generally. It could be about fiscal policy. It could be about monetary policy. It could be about government's approach and international relations more generally. So uncertainty takes many different forms. It can vary in terms of its scale. So you can get enormous amounts of uncertainty caused, for example, by the effects of the pandemic would be a good example, or you could get shocks that are relatively small in terms of the amount of uncertainty they generate. And then we have to consider the duration too. Periods of uncertainty that extend for a prolonged amount of time will create more economic damage than those that are relatively short in nature. Now, in the literature, most of the focus is on the effect of uncertainty on variability in future interest rates, prices, profits, and so on and so forth. And there is some academic evidence that suggests that greater uncertainty can depress economic activity. But the order of magnitude is uncertain. It depends, as I say, on the different forms of uncertainty, the duration, and so on and so forth. And I think to bring it round to what's happening today, yes, we've seen some weakness in consumer confidence, for example, in the US, but I don't think it's the case that uncertainty around these policies is having a major impact on either the US economy or the global economy for that matter at this stage.
But at one point, the Trump policy agenda will be seen in the data, presumably. And I make that point because we've got the February employment report a week from today, and there is a blizzard of news around Elon Musk's efforts to shrink the federal government. Is that something that's going to show up, do you think, in the February report, or is it in the following months? And is that going to turn what have been fairly tight US labour market conditions into fairly loose ones, into a more worrying situation for employment?
I think there's a couple of important points to stress here. The first is that it's fair to say that the speed and the scale of the federal government layoffs and cuts from DOGE have been perhaps greater than we had anticipated. With all that being said, though, we've had reports of widespread layoffs of more than 200,000 junior staff. They only really began in earnest around the third week of February, so they fall outside the survey period for the February payroll. So we shouldn't expect to see those show up in this month's data. What's more, those federal employees that have accepted a deferred resignation, we know there's about 77,000 of them a couple of weeks ago, they will remain on federal payrolls until the end of September, so will therefore be counted towards the payrolls number. So yes, the DOGE has moved more quickly than perhaps we anticipated, and the cut in federal government employment is perhaps going to be a bit larger than we had anticipated. But that's not going to start to show up in some of the economic data until later this year. And even when it does, actually, it's important to keep in mind, we're talking potentially of 300,000 or so employees so far in the context of an economy that added more than 1.5 million jobs last year. So it's not going to be nothing, but also it's not going to have a really substantial impact on the aggregate employment numbers.
Okay, but nonetheless, a hit to the employment situation, plus tariffs leading to higher inflation, plus this weakness in consumer confidence you already talk about. I mean, putting this all together, is there a chance that Trump takes a look at the byproducts of his policy agenda, and I think as you just hinted, just reins it all back in?
Yes, there's always a chance, isn't there? And it's possible too that we start to see a more adverse reaction in the stock market, US stock market, and that prompts a change in heart or change in approach. I don't think we're there yet. Trump had famously combustible relationships with several senior members of his administration the first time around, so you couldn't rule out the possibility that at some point the relationship between Musk and Trump, for example, will sour and Musk will retreat stage left, as it were. However, I think from a macro perspective, the point might be that the damage at that point is already done. Once you've started laying off a lot of these federal government workers that have substantial amounts of experience in post, you lose an awful lot of institutional knowledge and experience and expertise. It's not very easy to get that back. Possible, yes, that as we start to see some of the economic consequences, there's a slight change in approach. But I think at that point, the institutional damage may be done, and that could have long-run consequences.
Okay, I'd like to just step away from the US just a bit, because you talked about China's potential response to higher tariffs. And one of the big events happening the coming week is the National People's Congress in Beijing, starting on Wednesday. And it's quite the backdrop, isn't it, for this government meeting this year? At home, you've got an economy looking choppy at best, maybe signs of recovery, but nothing too stable there. Abroad, as we've talked about, US tariffs high and rising. The NPC is all about economic targets, signals that you get from government work reports and the press appearances that officials make over those days. In totality, how do you think Beijing calibrates policy this year with all of that going on?
Yeah, incredibly important question, this. In the next week or so, there's going to be a whole load of focus on where does the NPC set this year's growth target. And frankly, of all the mountain of statistics that are come out and be in press reports and analyst reports over the coming week, this is the least important. In a sense, it might set a floor under the official GDP growth numbers, but we know, for example, using our China activity proxy, that for a long time now, actual GDP growth, actual economic growth has undershot some of the official numbers. So don't focus on the GDP growth target. I think if you're going to focus anywhere, focus on the annual budget. That will give us a sense of the amount of policy support that the government is going to provide over the next year or so. Now, this is easier said than done because there's a myriad of on and off budget funds that you need to navigate. Accounting for all of that, we think that total policy support will be in the order, on the fiscal side, will be in the order of about 1.5% of GDP. And that's pretty large by the standards of most advanced economies, but it's not that large by Chinese standards. So in 2015, policy support was just over 2% of GDP, for example. In 2020, it was close to 4% of GDP in terms of fiscal policy support. So it's big by developed market standards, but relatively small in terms of Chinese standards. But then we also need to think about the composition of policy support too. In the past, an awful lot of fiscal spending, fiscal support has taken the form of public investment. Indeed, investment share of the central government budget is at a record high. It's close to a record high. So if we get more of the same, if we get more fiscal support aimed at infrastructure spending and investment spending, then the bang for the buck on that is getting lower because, as we've talked about on this podcast, China's suffering from overinvestment. So we need to think about the size of the amount of fiscal support, but also where it's being concentrated. Yeah, as I say, on that front, we think about 1.5% of GDP, but probably a large chunk of that going towards investment. Now, what does that mean? It's enough, I think, to generate a bit of a pickup in growth over the first half of this year. But once the effects of that policy support start to fade, we're going to get a relapse in growth over the second half, I think.
Neil Shearing there on China's National People's Congress and another week in Trumpland. Needless to say, on tariffs, we're watching the situation closely and we'll respond on Tuesday if the president does actually push the button this time. I will add our note about coping with uncertainty in the podcast notes. It's almost therapeutic in how it puts all of this noise coming from the Oval Office into its global macro context. On China, Neil mentioned the China activity proxy. I will put our last reading of that in the show notes. I'll also add an invite to our drop-in. That's one of our short-form online briefings that's being held on day one of the NPC. Julian Evans-Pritchard, our China economics head, will lead a panel to address your questions on growth, on investment spending, fiscal deficit targets, everything that's come out of the Congress so far. There are also drop-ins this coming week on UK housing and Egyptian economic reform. That should give you some sense of the range of issues we tackle in these weekly briefings. Stay on top of what's happening on our events page, capitaleconomics.com/events. You can register for those upcoming events and you can watch recordings of previous sessions. Now, on paper at least, India is one of the most vulnerable economies to higher US tariffs. Trump previously referred to the country as the tariff king, and he stood next to PM Narendra Modi at a presser in Washington just a few weeks ago saying that reciprocal tariffs are coming for India. This would be coming at a time when the Indian economy has been slowing and the RBI has been moving to shore up activity. So why isn't there much concern on the ground about the tariff threat? Deputy Chief Economist Shilan Shah has been in Mumbai talking to clients, but also to a range of businesses, government agencies, journalists, and more. And he's coming away with a sense that many think India can dodge the worst of it. He called in from Mumbai to give us a flavor of his discussions, and we started by talking about the general health of the economy.
The mood music, I would say, is one of cautious optimism. There's a general acknowledgement, I think, that the economy has cooled from its really quite breakneck speeds of growth in 2023 and early 2024. particularly when it comes to infrastructure projects, although many are also pointing to a slowdown in consumption. But looking ahead, with inflation now easing, the RBI beginning to ease monetary policy, infusing liquidity into the banking system, I think that there's a sense that the economy is soon going to come out of its weaker patch.
Talk about the RBI. They cut rates in early February, first time in nearly 5 years. There's also been regime change at the RBI. Talk about what that signals about the path ahead for monetary policy and what that should do to the economy.
Yeah, so it's clear that we're in for a period of easier or looser monetary policy. Now, we did receive some pushback amongst the people that we've been speaking to on the extent of policy easing. So we've had the 25 basis points cut to the repo rate already. We're expecting another 75 basis points of cuts, so a cumulative 100 basis points in the repo rate. People that I've spoken to are expecting a slightly shallower easing cycle, perhaps by 50 basis points, probably because inflation might start to pick up towards the middle of the year. Yeah, we're slightly more dovish than the consensus seems to be, but we expect the RBI to continue with another 75 basis points. Just given the extent of the slowdown in the economy, we think that it's going to go a little bit further than what many people are anticipating.
What ultimately is behind this slowdown in growth? Is it just that the economy is growing too quickly, or do you detect that some of the key drivers are faltering?
Yeah, I think it can be pinned down to two things. So one was the big boom in infrastructure spending in 2023, early stages of 2024, now beginning to cool. I think some of that was related to a bit of political uncertainty around the election, but also borrowing costs becoming higher. And the second factor is a slowdown in household consumption as well. That's really been evident in lots of the lower profile indicators that we look at. Things like vehicle sales, for example, shows that there's been pretty genuine slowdown in household consumption. I think a lot of that can be related or can be tied back to tighter monetary policy and higher inflation, which has weighed on spending as well. Both of those have now gone into reverse, which is why we are expecting a pickup in growth into the second half of the year.
And the budget that was announced beginning of February, to what extent does that recognise what's happening on the consumption side and what measures are in there that are going to support it?
Yeah, it was really interesting. I think at the time of the budget, it was pitched as pro-growth. So there were cuts to income tax, for example, changes in exemption thresholds. But people I've spoken to in India, I think, having had time to digest the actual measures in the budget that have been watered down since the initial announcement, get the sense that really this was a budget that tried to achieve lots of things, both in terms of boosting consumption, but also showing consolidation. It ended up doing more of the latter than the former. So it's now being read as a sort of prudent budget rather than one that's going to boost growth. I think a lot of the growth in terms of policy stimulus is going to come through easier monetary policy.
You talk about confidence that the economy is going to pick up, that the RBI is going to play its part, that the budget may help. There is enormous uncertainty globally about what's happening, what's coming out of Washington in terms of Donald Trump's trade agenda. What is the sense you get in India about how Indian exports to the US are going to be treated under this new administration?
Yeah, this is obviously a really hot topic. The Trump administration appears to have shifted away from universal tariffs and towards reciprocal tariffs. And if that is the strategy that is pursued, then India would appear to be one of the most exposed countries pretty much worldwide. Yeah, on the face of it, I think it's very worrying. I did get the general sense, though, that most felt like it was unlikely that India would be hit quite so hard. We had the Modi-Trump meeting in DC a couple of weeks ago. That came up quite a bit, with many seeing the outcome of that as evidence that Modi's going to make concessions in order to appease Trump. So import duties on products like motorbikes and bourbon whiskey have been lowered. India's agreed to buy more oil from the US as well. Yeah, of course, we can't dismiss the risk of Trump's tariffs completely by any means, but there is a sense that it might not be as bad for India as perhaps initially feared when the talk of reciprocal tariffs first came up.
So is there any sense that the uncertainty posed by Trump's trade agenda is going to affect investment sentiment? We've seen other examples where, a business that was planning to expand may be holding off on that decision because they want to see exactly what comes out of Washington before they push the button on that investment. Is there any sense in India of similar uncertainty?
I think that's certainly been playing out in the markets. India's equities have been struggling really for the past sort of 6 months or so. And uncertainty related to tariffs, I think, has prevented a rally so far this year. It's much harder to make that assessment when we look at direct investment. I think the case for investment into India is still a pretty strong one. It becomes stronger if we think that Trump is going to go after China, for example, with very punitive tariffs. It's difficult to say for now whether it's affected direct investment. Really, it comes down to an assessment of whether you think these reciprocal tariffs are going to be implemented in full. And if that is the case, then yes, of course, that's going to be a real big dent to sentiment and inward investment into India. But if they do get watered down, which seems to be what the general sense is, then perhaps it's not such a big headwind for direct investment in the future.
You mentioned the China threat. From your conversations on the ground, I mean, what's the perception of how India fits into this Trumpist worldview?
Yeah, it's really interesting. I think India is now seen increasingly, both externally and internally, as the big sort of geopolitical counterweight to China. And because of that, there is this underlying sense that Trump may not target India with sort of punitive tariffs, as we've mentioned. Equally, though, the uncertainty or the volatility created by Trump's trade policies and some of his announcements means that India, as well as many other countries and emerging markets, can't take anything for granted. So the perceived sort of benefits of aligning geopolitically with the US may now be smaller, and the perceived threats of doing so perhaps slightly bigger. And if that is the case, then there is a sense, I think, to at least keep relations as cordial as possible with China. There has been a thawing in relations over the past sort of 6 months or so, some agreements reached on the disputed border in the Himalayas, India appearing to open up towards more imports from China. And I think that is a strategy that it will probably continue to pursue. And really, it's in alignment with its historic non-committal or non-aligned stance in the big sort of geopolitical divides. India remained non-aligned throughout the Cold War, for example. So I think it's going to essentially be playing both sides in this new era.
That was Shilan Shah on a call from Mumbai. I will add our latest India report to the podcast notes. It's our weekly wrap-up and includes stuff on tariffs, on the RBI policy, and our latest long-term India forecast. But that's it for this week. Don't forget, if you ever want to get into the weeds on any aspect of our analysis or any issue in global macro and markets, contact your account manager who can set up a meeting pronto. But until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.